Now it's time to bring in my co-host Jeff Small, along with our special guest and friend, Chief Economic Advisor of Allianz and New York Times bestselling author, Mohamed El-Erian. Mohamed, thanks so much for being back here with us.
Thank you for having me.
So it's interesting. 2 months ago was when we spoke last right here on the same air. And you were being a little ambivalent as to whether you thought the market would have another major pullback or would run up. But you advised people to be cautious, to enter the market cautiously with the most conservative holdings. So are you even surprised with the level to which this stock market has recovered over the last 2 months?
I am, but it's understandable. First, the up in quality trade that I recommended 2 months ago actually outperformed the market for most of the last 2 months. So if you look at the names with a strong balance sheet, good management, positive cash flow, and on the sunny side, they did very well. What we've seen recently and has really powered this market up is the rotation trade. And that rotation trade basically has meant that people feel now confident investing in the names that have lagged. Airlines, hospitality. And it shows you that the market is comfortable with the win-win notion. You win by betting on a recovery, but you also win if it doesn't materialize because the central banks have shown over and over again their willingness to support this market. And that is now deeply ingrained in the conditioning of investors.
Got it. So that's the market. I get that. But how about the economy? As an economist, I have to ask you, it seems hard for me to believe, at least, that the economy at the end of 2020 will get anywhere near to the levels it was back at the end of 2019.
That's absolutely right. And I hope we get there by the end of 2021. It's what's called the checkmark recovery. You come down very suddenly and then you start going up, but very gradually. And the recovery is long and the recovery doesn't allow you to recapture. Look, David, the numbers are still horrible and they'll continue to be horrible for most of the second quarter. We're going to be looking at the GDP expansion at this contraction of 30%, if not above that. Sure. We're going to be seeing unemployment rates above 20%. So yes, the real economy has been hit hard. And what a lot of us are spending time on is not just when will the recovery occur, but what are the long-term scars? Because you can do something about them now if you can identify them early.
Sure. Jeff, I know you've got some things that you want to ask Mohamed.
There's a million things I'd like to ask Mohamed, but I got to tell you, what great refreshing remarks, Mohamed, that you're sharing with us, and it has been quite the recovery so far. I guess the biggest benefactor of this rising market and this checkmark snapback that we've had really is the NASDAQ. We got 38% of the NASDAQ is at all-time highs. We hit a high here yesterday in the NASDAQ. It's crazy what's happening. Can you shed some light on why the NASDAQ is the COVID-19 winner in the market right now?
So Jeff, ironically, the NASDAQ has a lot of the conservative names that I like. So as I said, what are the conservative names? Strong balance sheet. So think of Microsoft, think of Alphabet, think of different companies. They have a lot of cash. They're generating cash all the time. And you want to be cash rich. Investors are comfortable with that. They also happen to be on the sunny side of the migration from physical to virtual. And I think there's now more understanding, Jeff, that migration is not going to be fully reversed. So these companies benefit not only during the unsettling journey, but they benefit in the new destination. And that's why the NASDAQ is doing really well. The real test is going to be, do investors continue to embrace the rotation trade? Do they now feel comfortable betting on cyclical, betting on the old established industries? That's a tougher proposition. Let's hope it continues, but that's a tougher proposition given the reality of the economy.
Well, when is the reality of the economy going to be priced into the market? Because it looks like the market is pricing itself out 12, 13 months at this current valuation. When are those two lines going to actually become one, Mohamed?
When central banks get out of the way. The reason why we've had this massive wedge, and I can take you to parts of the market, high yield, for example. where we have seen an amazing compression of default likely names. Think about that. Default likely names are coming down. Any company can issue, and we issue. It's the central banks. The Fed did something that, Jeff, honestly, not just surprised me, but disappointed me, which is it's one thing for them to support money market funds. It's not also supporting the treasury market, supporting liquidity, even supporting investment grade names. But they went into high yield. They started buying default likely names. In fact, they owned the NASDAQ, they owned the high yield index, which means they owned JCPenney, Neiman Marcus, and Hertz, all of which are in bankruptcy procedures. And what that has told the market is that this is the Fed is willing to take on default risk. But what's the next stage in the capital structure? Equities.
But yeah, the next stage, Mohamed, is they start buying equities, and at that point, that disconnect just gets wider and wider and wider, which is absolutely incredible. But we can take a quick commercial break. So stay with us. We'll be back here in a moment with much more in terms of words of wisdom from our good friend Mohamed El-Erian. We'll be right back. Now let's bring back my co-host Jeff Small, along with our good friend and special guest, Chief Economic Advisor at Allianz and New York Times bestselling author, Mohamed El-Erian. So, Mohamed, you know, we did a whole show last week, Jeff and I did, about whether it's going to be U-shaped, V-shaped, W-shaped, L-shaped, and now you gave us the dreaded checkmark shape, at least on the economy, with obviously what's happening is a V-shape on the stock market. But do you think that with this step that you said disappointed you, with the Federal Reserve now getting into junk bonds, do you think that those two lines will ever come together, as Jeff asked, or do you think we could be in a time now of a new norm with really two disparate sets of books, almost, if you will, kind of like the mafia? You know, you got two books. You got the book for the economy, and then the book for the stock market, which is, you know, supposed to be reflecting the economy, but maybe no longer will.
So I can only think of two ways these lines come together: a good way and a bad way. A good way is that the economy picks up steam much faster and we validate elevated asset prices. The bad way is either the Fed exits suddenly and the markets basically hit a massive air pocket, or alternatively, we get massive bankruptcies. Because the one thing the Fed cannot protect against is capital impairments, right? What you're going to get is the two lines merging slowly, both from above and from below. And where policy comes in, David, importantly, is that it can accelerate the convergence from below. It can accelerate the economic recovery. David, you heard me say this over and over again. It's not just enough to win the war against a global depression. We have to secure a piece of high and inclusive growth.
Absolutely. You know, it's funny. I end up disagreeing with so many people with things. I disagree with Jeff on some things. And one of the things I disagreed with you on, I want to see if you changed even just a little bit from 2 months ago, is I think in time we are going to go to negative interest rates by the Fed. And you said, well, I really don't think that's going to happen. Have you, now that they're buying junk bonds, have you gotten a little more liberal on their thinking perhaps, or do you still feel like it probably won't happen?
So if you're asking me what should happen, that's an easy answer. They shouldn't go negative.
Of course.
If you ask me what will happen, I can no longer predict this Fed. This Fed has done things that puzzle me. So I can no longer predict that Fed. So I think you were ahead of me as usual in saying, look, keep an open mind. And this Fed has proven that it's willing to do things. But the evidence, David, is pretty convincing that you better have really good reasons to do it, because the unintended consequences are large and getting out is almost impossible. It's like no exit. It's no exit. Once you in.
Yep. Again, I don't know why I'm talking about the mafia so much today, but it's kind of like the mafia. You know, you can get in, but you can't get out. So I agree completely, and thank you for your humility, which I love so very much as usual, Mohamed. Jeff?
All right, Mohamed. So Dave and I have had a running feud the last 3 or 4 shows. I've been bullish, he's been bearish. And so you're going to have to break the tie for us here. We're counting on you to not let us down. But I got money on you that you're going to lean in my direction. The market's going to be a little more bullish here. As long as we don't have a second wave, animal spirits are alive, steepening yield curve, dollar is falling, market is getting hotter. You know, like you said, cash balance sheets are hot right now. There's a rotation in and out of the COVID stocks.
Hold on, Jeff. This is what the attorneys will call leading the witness. No leading the witness. Let the man answer, for goodness sake.
Okay. I'm sorry. Go ahead.
So you said as long as we don't get an increased infection rate. I mean, that's important. Look, I'm gonna say something that sounds very contrary. And I'm really glad I'm not managing other people's money, because I would have enormous difficulty managing other people's money. I think in the short term, the market goes higher, but I am not comfortable participating in this rally, because you are basically betting on central bank moral hazard, and that's something I don't like doing. So will the market go higher? Probably, but it's going to go higher for the wrong reasons.
Interesting. And I guess that's been my thought too, as Jeff and I have had this disagreement, is that my approach has been, even if you're right, Jeff, at the end of the day, do our clients who are very conservative, who are all over age 55 years old, do they really want to participate in something that's essentially artificially levitating without any real fundamental support, or at least not enough fundamental support? So we got about 1 minute left. So I asked you this last time, I'm going to ask you again. Talk to our income generation members, those viewers and listeners who are over age 55. What's your best advice for them at a time like this?
My best advice for them is be careful of what you're being asked to do. So by going ever lower on interest rates, and by basically wants you to take equity risk. That's what they want you to do. Not because it's in your interest necessarily, but because that's how they hope to get the economy to recover. So if you do that, understand why it is you're being asked to play this game, and make sure you can afford a mistake, because you are entering into deeper and deeper default risk.
Well, that's something that you and Jeff and I all agree with, for sure. So I have to ask you, Mohamed, seriously, you know, over the last 2 months, since last time we've seen you, your hair seems to have gotten a little grayer. Is that in part because of what's going on in the economy and the stock market right now?
So I'm getting older. That's one. Two, my hair is longer than usual.
Yes, I know.
That's two. And three is I've been waking up at 2:30 every morning. So I'm going to get grayer and grayer. I did have a beard for a few days, and the family vetoed it.
They vetoed. That's great. Well, all I can say is, for your sake and others, but for your sake also, I hope we don't have another uptick in infections, because 2 months from now we might have you back on the show. You might be totally white-haired. So we'll look forward to seeing what you're looking like in 2 more months. Mohamed, as usual, thanks so much. It's been our pleasure having you.
Thank you very much. Thank you, David. Thank you, Jeff.
And you stay with us too. We have more coming up in just a moment right here on the Income Generation. We'll be right back.